And you can see the evidence of that. Going down these areas, you can see those houses that are boarded up, those houses that had a fire and were never repaired. You see those one after the next after the next. I mean, that you can succeed in these areas, but it's the opposite. A lot of newbies, the 2% rule pushes new investors into it. You need to be a specialist. Like, this is your niche.
Welcome to the Good Stewards Podcast, the only podcast dedicated to seasoned real estate investors who want to maximize the cash flow potential in their business. We are buy and hold investors with 1,000+ properties and markets across the U.S. who bring an insider's view into the nitty-gritty details of real estate investing. If you're looking to develop the mindset, teams, and systems that can dramatically build your real estate business and net worth, you're in the right place.
Welcome to this episode of the Good Stewards Podcast. I'm Ryan Dossie.
I'm Amanda Perkins.
I'm Bill Sirius.
And I'm Andrew Sirius.
Hello, everyone. Welcome to the Good Stewards Podcast. We are going to be diving into all of the myths of real estate investment, all the things that people believe that just ain't so. But first of all, please remember to go to our website, thegoodstewards.com, download our free ebook. And also, if you enjoy our content, please share our podcast with on Facebook, other social media. We'd really appreciate it. So without further ado, let us dive into the topic at hand. And the first myth, I think, of real estate is sort of a myth that has been perpetuated by the gurus of sort, particularly the gurus of the late 90s and early aughts, which we'll go unnamed. We won't name the guilty. But that is that real estate investment is basically a get-rich-quick scheme, or it's something that you can reach financial freedom like that. And it's not. Real estate investment is the ultimate get-rich-slow scheme. It takes a long time to build up wealth with real estate. And I mean, with flipping and things like that, you can make a large profit in a fairly short period of time. But even then, it takes a while to ramp up your operations. It takes a while to go through the whole process, to start marketing for a flip, to get it under contract, to do the rehab, then to sell it. And generally speaking, early on, you're probably not going to do it right. You're probably going to struggle. Josh Dorkin at Bigger Pockets says, you should expect to lose money on your first flip. I mean, so it's technically possible to make a very large profit, but it's very unlikely that you're going to make such a large profit that all of a sudden, boom, you're rich. And again, we are strong on the buy and hold side and believe that is the way to wealth with real estate is buy and hold. And that requires, yes, getting some equity up front on a good deal, but it also requires paying your principal down over the years. And if you look at an amortization schedule, even a 20-year amortization, you don't pay off that much principal up front. It accelerates as you go. That's pay off some, that's great. But again, you're chipping away at it. Market appreciates, generally speaking, but we're talking a couple of percent a year. Maybe I think the average over the history is about 4%. So that's nice. But this is a slow process of building wealth, not a quick way to get there. And I think those unnamed gurus of the late 90s and early aughts in particular, but there's some still around, have done a great disservice to aspiring real estate investors by perpetuating this myth.
Yeah, I think on that kind of perpetuated myth with the get rich quick is the word passive, right? Everybody, I think it's funny because a lot of people who get into real estate investing are people that they always pay their bills. So they couldn't fathom that somebody would just not pay their rent, right? I know for me anyway, early on in property management, I was like, this is one of the guys in our office has described it as sometimes it feels like herding cats, right? Like you're trying to get people to do something that really they should do, but they're not. So I think that's another thing to address is that it's not really this fairy tale of you cut a check or maybe you buy a turnkey property or something and it's just mailbox money. I mean, it still is work.
Well, and just to clarify, there are passive investors out there. Those are people that already have money. They have lots of money and they get to say, here, do something with my money. I'll sit back and wait for my returns. But our audience and probably us, I mean, not probably us, for sure us, we're working in this business every single day. And yeah, sometimes we consider our passive investors to be our private lenders, but on a bigger scale, that does exist. It doesn't exist for somebody who's trying to grow their business.
Or who's trying to build a portfolio.
Yeah, passive real estate investing is like investing in the stock market. And that's when you'll see those articles that say like, okay, real estate, the returns on real estate will be in between, they'll be higher than bonds, but lower than stocks over the long term, because real estate is riskier than bonds, but less risky than stocks. And that'd be like investing in a REIT or investing passively in a syndication or something like that. And that's all well and good. We're not trying to dissuade that type of thing, but it's not the type of active real estate investing that we're discussing most of the time on this show.
You need to start with a few million, sells less well.
Yeah, trust fund babies have an easy way to earn millions and millions more because they start with that. But I think
how to become a millionaire, start out as one.
Yeah. Or according to Sir Richard Branson, how to become a millionaire, start with $1 billion and then buy an airline. So that was his.
So it's easy peasy. Let's just do that.
But I think the key here too is that oftentimes passive investment is kind of seen as a solopreneur, where you kind of this independent millionaire mindset person. But I don't know a lot of millionaires, and but the ones that I do have large organizations. They've built an infrastructure, and that infrastructure is expensive. Every person that you hire on, every piece of, every rent that you pay, every utility you have to pay for yourself to get into business, your phone lines, on and on and on. It's all expensive. So you have to factor that in as you're growing a business in terms of what it's going to cost. And often buy and hold investment, I think, is survive till you thrive. I would put it that way.
I think it's also one of those, to kind of touch on that, of if you wanted to do it all yourself and work 100-hour weeks, you could quote unquote cash flow, $10,000, $20,000 a month. But like, I've got the expression, like, you can build businesses that serve you or enslave you. It's your choice. And I feel like that's kind of how this goes of, are you going to hire people that are smarter than you in the roles you're hiring for? Or are you going to try to keep every single dollar and do it all yourself? And, I agree, Bill. I haven't met many people who are very successful or very affluent who are control freaks that do everything themselves. Now, I've met some control freaks that are very successful that have staff, but I think that's a good differentiation to make.
Yeah, you want to do what you do best. I mean, this is getting into other myths possibly, and what do you do best? And then you hire the rest, or you sub out the rest, because you can't do everything. Being a jack of all trades is really kind of a recipe for mediocrity is what it is. So focus in on what you do best and let others excel in what they do best, but find those people as fast as you can.
That being said, finding those people involves growing one step at a time and not becoming rich quickly. Real estate takes time. It's a matter of patience and perseverance. But let's move on to topic number 2, the second myth of real estate. This is a buy and hold myth, and it's the dreaded 2% rule. This rule has kind of gone out of favor as the markets continue to appreciate, but it should have gone out of favor from the very beginning. It should have just died on arrival because it's garbage. The 2% rule says that you should invest in buy and hold properties and rentals that the rent is 2% of your all-in cost. So if the all-in cost is $100,000, your rent should be $2,000. Now, anyone familiar with most markets knows that this is just simply unattainable. And nowadays it's pretty much a joke, but even 5 years ago, 6 years ago, it really was a rule because rents go up slower than prices. And the reason this is the case is because, especially when you start to get into homeowner markets or markets that have homeowners and investors, the rent, the basically income potential of a property becomes less and less relevant. You're now competing against people who need a rental income and also against people who want to just buy the house because they want to live in it. And so they're willing to pay more for it. And that bids up the price of the property above what it simply will rent for. In the lower end, so rents go up slower than prices, generally speaking. What the rule does then is push people towards the worst areas. especially new investors. It pushes them towards just these areas where, the crossroads of Warzone and Skid Row, where that intersection meets by the house right there that's boarded up and dilapidated and hasn't been occupied for 17 years.
Make sure it's on a busy street too, because that's really important.
Yes.
I think Ben Leibovich calls these $30,000 Midwestern pigs. So,
no, he doesn't have good things to say about them.
And they don't work out well.
Yeah, you want to talk about the passive piece. Good luck collecting rent from somebody paying $600 to be in a $20,000 house.
Yeah, that's the problem. These properties only, they look good on paper, but they only look good on paper. Because the issue, like a roof costs the exact same on a $50,000 house as it does on a $200,000 house, square foot for square foot. Some items might be cheaper. The countertops might be cheaper. The refrigerator might be cheaper. The furnace isn't going to be cheaper. A square foot per square foot. It actually might be more. Replacing a wall might be more expensive because it's old plaster and lath and not newer drywall. Same, you might have to replace plumbing because it's old galvanized plumbing and not newer stuff like PEX. So there actually might be more expenses in that regard. So your expenses, your operating income will not cover your operating expenses on these properties. And the only way to make it, and so every month you're bleeding. It's harder to find good residents. There are plenty of good residents in rough areas, but it's harder to find them. And it's more likely you'll have one who's trashes the house. And one of those on a $50,000 house that rents for $500 or whatever, is going to take a lot longer at $500 a month to cover a $5,000, $7,000, $10,000 turnover than it would at $1,200 a month or something like that.
And one thing is, I feel like when you're trying to make those, you're a landlord struggling, or maybe you're not struggling, but you're making those repairs and you're like, I have to replace the plumbing in this house, and that's $15,000 and my house is worth $20,000. Like, that's a tough pill to swallow. So at some points you're like, well, I'm just going to walk away. I mean, it's not something that's worked out for us.
And you can see the evidence of that. Going down these areas, you can see those houses that are boarded up, those houses that had a fire and were never repaired. You see those one after the next after the next. I mean, that you can succeed in these areas, but it's the opposite. A lot of newbies, the 2% rule pushes new investors into it. You need to be a specialist. Like, this is your niche. And
in my experience, the people that do well in these areas grew up in these areas. They live in these areas. They know the people, or they're somewhere like a cross between like a mafia bookie collector and a slumlord. Bill and I looked at a portfolio of these, and the guy actually told us when we were looking at him, well, people know if they don't pay me that bad things happen. And it's like, well, that's not how we run a business. So this portfolio is not for us.
Yeah, and I remember looking at a multifamily in a similar way, Ryan, where we were met by the property management company, and they said, well, we always come down here to collect rent in cash in person. That wasn't a real good sign for me that this was a long-term hold that I wanted to get a hold of myself. If that was necessary, that's not the area of town I want to be in.
Yeah, Bill and I looked at one here in Indy that the quote unquote property manager met us at, and it was one of the tenants who was making a tuna casserole that was going to be what he ate for 3 meals a day for the week. But what made it even better was he met us in a robe and had a giant pair of tweezers and was smoking cigarette butts he picked up from around the grounds. He called it short butting it.
That's economical. That's saving money.
I don't think this is the property for us.
I would mention one more thing about the 2% rule before we move on. And that is, some people have changed it to the 1% rule or things like that. The 1% rule is certainly better. But generally speaking, the best thing about the 1% or whatever rule is to compare properties in the same area. So if this property is very similar, like is in the same general area as this other property, this one's a 1%, that one's a 1.2%. It's sort of a way of doing a rental comp on that area. Comparing across areas is generally a bad idea. And so, because again, certain areas, operating expenses will outrun your operating income, and you're just going to bleed every month. And so they're not really comparable. And so I would use them as a way to compare properties in the same general region, and even be careful with things like the 1% rule, because they can be misleading.
I mean, I would say throw that out the door and do your own analysis every time you're looking to purchase a property, and be realistic. Look around, kick the tires, figure out what really needs to be done. So you're not, I think we've said this before, but I'll say it again. Don't always go in with best case scenario as your expectation.
Don't ever go in.
Don't
Well,
ever.
and I think the goal, the ultimate goal is to cash flow being fully financed. And that may not be up front, obviously, when you're doing value add and you're rehabbing the property, and maybe you have a higher interest loan on the property from a private lender or hard money lender. But ultimately, when you burr the property out and you come around to refinance that property at the lowest possible interest rate likely from a local bank or regional bank, then you want to be in a position where you actually are making cash flow and you're fully financed, or could be fully financed and still make cash flow. That's your goal. And when I got started, and when the pinch came to shove, and things were tight, no question about it, because you had to add up all your management expenses, your maintenance expenses, and all those expenses had to go along with your PITI, principal, interest, taxes, and insurance. So, I felt like if I could make $1 cash flow and everything was paid, actually every single expense was definitely paid, then that was something to consider. Other people have a higher margin, and I understand that, but when it's tight, that's something to consider.
I think it's good words of wisdom, and we should probably move on to the next point before we run out of time here. So the next point is cash flow. Cash flow by itself will make you rich. And I think there are some people who believe like, I'm just going to build up a portfolio and live off of $5,000 a month in cash flow. And cash flow is nice. It's a good thing. And it eventually can get there, but it kind of goes back to the first one. It takes its time. Real estate is a slow method of building wealth. And
well, especially if you're following what Bill just said, and you're getting $1 of cash flow.
Yes, if you're following that,
5,000 properties.
Yeah, that will take some time. I would generally push more for closer to $100 per unit. But even still, if you have debt on properties, you are not going to cash flow that much. I mean, on a large apartment complex, you'll cash flow some, sure, at least you better. On houses, small multis, it's going to be fairly tight. Even if you're cash flowing $50 to $100 a month per unit. I mean, just thinking that conceptually, how much money do you need to live off of? If you have a family, it probably starts at like $2,500, $300, and that's absolute bare minimum in a Midwestern cheap town. And so that's 25 units. Most people, that's quite a few for most people. So
I think the thing we're discussing here is really kind of a mindset shift from a small mom and pop investor to looking at this on a larger scale. And that's on the larger scale where you're really making your money and building your wealth is in the debt pay down. It's in the property cash flowing enough to pay for itself. And maybe you get some appreciation, but as that debt gets paid down and paid off, if you have $10 million worth of real estate and you finance it on a 15-year AM, it's paid off in 15 years. You now own $10 million worth of real estate that's appreciated free and clear. I think most people would argue you are now wealthy. But I think it's different if your goal is like, well, I'm going to get $5,000 and then quit my job. I mean, first off, is that really all you want out of life? Would be my first question. But I think it's also, do you want to ultimately have to do everything yourself because you can't afford to hire because you're living off?
Yeah. And I think when you combine the idea that this is a get rich slow scheme, so if the myth is that cash flow, you're going to have lots of cash flow in real estate. I think the unmyth is that the way you get rich in real estate, and I think you touched on this, Ryan, is through refinancing. And that means you've got to see it as a long-term get rich slow scheme, because refinancing is not going to happen for 5-10 years down the line.
Best case scenario, likely more than that.
Best case scenario. Yeah. And that's if you have an appreciating market. If you don't, then you're just paying down your mortgage, which you will over time. And many Midwestern markets lenders are on a 20-year amortization cycle, which sucks at the beginning, but it's pretty good when you get towards that 20-year mark. But at that point, when you refinance, that's when you get rich. And that's when you bring in cash that, yes, you increase your indebtedness again, but you bring in cash that is not taxable. So it's like, oh, 100,000 here, 100,000 there. And I don't pay any taxes on that money.
And I just want to add one little caveat. When you go and sell the property, you still owe the tax on your purchase plus what you're into it, and recapture that depreciation and the difference between your sales price. And if you refinanced many times along the way and took out lots of money, you're going to owe the debt. So just, yes, when you pull that refinance money out, initially it's not taxable. At some point down the road, there will be tax to pay on it. It just depends on who's paying it.
So another thought
Someday,
is to just
the government always gets its money.
or let somebody else inherit that property. So the tax basis goes up to zero, and they can start all over again, which is pretty cool situation.
Bill's a fan of buy and hold for any of our listeners, and buy and hold forever at that.
Yeah.
I think it's safe. I think we've moved a little bit off the original point, but the original point is that cash, the mindset of I'm going to live, again, back to this, I'm going to live passively off of my passive income from these real estate. Eventually you can get there, but it's a very long-term thing. And really the way to get high cash flow, particularly from single family and small multis, is having no debt or paying off your debt. That's how you get high cash flow. But of course, as you just mentioned, Ed, pulling out, refinancing out that equity is a way to get a large amount of cash. So there's different ways to play real estate in the long run. But the idea of living off their cash flow in the near future or even in the intermediate future is really kind of a pie in the sky thing and not something you should expect going in.
I think the other thing to keep in mind too is if you're pulling out all the cash flow and you decide you want to upgrade a property, where does that money come from? Right? For me, I would rather, flip, wholesale, do some other things to pull in some cash to pay my bills. That way our properties can be upgraded by our portfolio, right? Because it's, we may have done a rehab now and that's all fine and dandy and the property looks great, but 10, 15 years from now, we're going to need another remodel. And if I've pulled out and lived off of every dollar of cash flow, where's that going to come from? So I think it really, I don't know. Maybe it's like the Southern California prices that have, ruined my expectations of what's reasonable to live off of. But, when I started, it was like, man, if I could just get $3,000 a month, I could retire. Right. Now it's like, I don't know total what we're collecting in rent, but it is way more than I used to make a year per month. But it is a business. This isn't something that I think it's like any other business. If you suck all of the liquidity out of it, you're going to bankrupt it on itself. So that's my personal opinion.
So is the unmyth here is even though the eye of ideal, which long-term buy and hold rental properties it's an ideal investment, but the income, which is the I, is something that you need to defer and to put back into the business, just like any new business that you would start. You want to put every resource you possibly can, which kind of moves into the idea of living modestly and, having a mindset that I would rather, there's a great, I think a great movie out called Broke, which it talks about professional athletes who many of which by 3 years after they're finished with their careers go broke. And a line in that said by one athlete who did it the other way, he did it the right way. He said, I'd rather live like a prince for a lifetime than a king for a year. So you have that kind of mentality. Look, I'm going to save what I have. I'm going to live modestly. I'm going to invest what I have prudently so that in the long run, things will go well in my financial life.
Bill's not getting bottle service at the club.
What club?
Exactly.
I've never been to a club in my life.
Let's keep on here, and we'll move on to myth number 4. Myth number 4 is one we've touched on before. You can check out our episode on rehab, but the myth is that rehabs will come in on budget. I guess that's the best way, particularly early on. Rehabs, they can come in on budget especially if you really go through a property diligently, create a long, specific scope of work, add in contingencies for add-ons, things you didn't see, get inspections before, and do your due diligence up front. But they will not come in under budget. They often go over budget. I've heard plenty of people complain about budgets going over. I think we all have experience with that having happened. I have never yet once heard from a real estate investor of any sort saying, yeah, I have a problem with, I'm always budgeting too much. I'm borrowing too much to do my rehabs. Or anything like that. I'm not getting I'm not getting enough deals because I'm bidding too low because I put too much in there for rehab. I've never heard that complaint. I've never even heard it with specific properties. Like we'll have this one came in a little under budget. That's great. But I never hear it wasn't.
We just had all this extra cash sitting around. What I typically find is if you're trying to cut your budget before you buy the deal to try to make it work, you should not buy the deal. I have a few in mind that it's like looking back, I don't know that we should have bought this one. And they were ones that it was like, well, if we just do this and this, and, maybe if we go like lower ends, like if you're trying to sell your contractor on charging you less so you think you can make a deal work, at the end, you're either not going to finish the project, you're going to run over budget, or you're going to have a property that you're just not totally thrilled with the condition of.
There's a word for that. I'll cut my budget. It's called change order. When they come back and add back in what they told you in the first place it would cost, you'll pay for it.
I think the other thing too is not underestimating what you want the finished project to look like. Bill and I have had a few that we initially bought and we're like, oh, okay, it's, on a boiler and that's fine. And then we decide, or in the one I'm thinking of, our boiler started having issues and it was okay. We're going to move to HVAC, which was an electrical upgrade plus the HVAC. And then it was like, well, we've got these really nice units that have everything but washer and dryers. So I guess we'll put in washer and dryers now. So I think go in with, begin with the end in mind. That's a quote
Stephen
Bill
Covey.
likes. Thank you. Stephen Covey.
Stephen Covey.
If you go into it thinking like, okay, we're just going to carpet and paint it, you got to be pretty careful. Like, what does the rest of it look like? What do the mechanicals look like? Otherwise, you're going to end up with stuff that, you're pretty much a slumlord by accident.
Yeah, and rehab by its very nature uncovers things that even a diligent property inspection doesn't see. We were just 2 days ago, some guys who work for me called me up and said, "Hey, Bill, you got to come over here." They were putting up a fence. I hate to get those calls, that. And as they were putting up this fence to the side of this fourplex, they had noticed that the siding was really, really spongy right there in the corner. And then we looked at it more closely. Oh, yeah, it's kind of diving into that corner, as a matter of fact. And we realized that over many, many years, there'd been water seepage behind this area. And so what do? Well, it's on the agenda to get it fixed, but that all costs money. Money that
yes, you seal all of that moisture, and it always works out the best.
So
shellac it.
So budgets grow; they don't shrink when you're doing rehab generally.
Yeah, so it's just this is one of those things where it's not you're aiming for the middle and you're trying to hit the golf ball straight down the course, and you could either hook it or what's it
slice
called? Slice it. You can either hook it or slice it. No, it will always be a slice unless you're right down the middle. So think of it in that way. Mistakes are almost always in one direction.
Put in a few percentage of cushion.
Yeah. Make sure to put a contingency in there. Let's go to the final one here to wrap up the show, and that is that third-party property management is a cure-all, or it's just a way that you can pass. Kind of going back to this mindset of thinking
it passive.
You can be passive. You can buy properties, buy and hold, and do it passively. Now, I don't want to diss all third-party property management companies. There are good ones, and there are ones that can do very well by you, but it's not a passive experience. First of all, you want to find them, and that needs to be an active effort of asking for references, of calling several, of interviewing them, of interviewing their interviewing some of, getting references, interviewing their clients, and kind of going through all of that. Then you want to follow up on them, get reports from them on a regular basis about the rent roll, your income. Make sure that
you still have to manage.
Yeah, you have to manage it. Make sure that they're screening properly. Make sure that they're collecting rents. Maybe go check on the vacants. Make sure that they did proper rehab turnovers and things like that. Check off on their bids when they're doing those turnovers. And so you have to manage a manager if you're going to. You have to be diligent in finding one. You have to manage them well, and you have to be willing to leave them if you're going to use them. And so. And also, there unfortunately there are some ones there's some bad ones. There's some ones that are over their head. It very well might be better. Like, we manage ourselves and generally recommend that. And that obviously isn't an easy thing. But third-party property management is not just something you can turn the keys over and it's done.
I think it's a moving target of like, even if you hire a property management company that's great, that everything's awesome with, it's still a people-based business. So as people turn, as people come and go, policies and stuff changes, your experience may start to go downhill. A lot of property management companies, I'll see reviews that were like, oh my gosh, these people are best thing ever. And then like all the recent reviews are downhill. So I think you have to do the same thing in your own business with your own staff of like, it's a moving target. You have to stay on it. You have to manage it. It's not going to, I think the biggest lesson I've learned in property management, and property management has kicked my teeth in over the past few years, is like, you have to stay on top of it. Just because you told somebody, it's like trust but verify. Same thing, whether it's your own staff, whether it's a property manager, you have to be in there looking at it, knowing what's going on. And I would argue actually the larger you get, the more dangerous this gets. Of you let things slide for a few months on a 400 unit portfolio, that can cost you a lot of money.
And I think you want to be committed to get inside your property at least once a year, even if it's out of state. Just thinking of yourself on cruise control is really a recipe for disaster in business. You're still a business person. The other thing that
I would add to this is, if you're going to go and interview and look for property managers, try not to do it as getting the best deal. Try not to do this about money, because in full disclosure, it costs us more than 10% to manage ourselves, but we're willing to do that because we do a really good job with it and we can make up with it in other ways. Lots of people want to negotiate that down. And, there's not a lot of money in property management when you go and do the math, especially if you look what they're doing. And so if you're just really just trying to get the best deal out there, it might cost you more than that percentage point that you're trying to negotiate with your property manager.
Consider, and this isn't pejorative, but I would consider property management as the blue collar work of real estate investment. And blue collar work is really, really important in our society in general, but it is grinding it out type of stuff. It is taking lots of phone calls, being involved with people who are upset at times, and dealing with disappointment and situations that you'd just rather not deal with. But so it's a tough business, and those people should be paid well for it and appreciated for when they do a good job. I think
the last thing to keep in mind with it is that these are still people. I hear a lot of real estate investors talk about their property managers like they're just like, the scourge of the earth, or that it's somehow the property manager's fault that a tenant didn't pay rent, or, you have to look at these as this is a working relationship. If you go into a property management relationship with the understanding of like, they're going to handle everything, it's going to be perfect, I'm never going to have to deal with anything, I'm just going to get a check in the mail, you're setting yourself up for failure. You need to realize like it's going to be a working relationship in which problems do come up.
You make your money when you buy, but you retain your value when you manage well, or have somebody manage well for you.
Or manage your managers well.
And on that, we will wrap up here. Those are some of the myths. There are more. Maybe we'll have a follow-up episode on additional myths. But for the time being, please, again, thank you for joining us. Please see us at our website, thegoodstewards.com. Download our free ebook. And if you enjoyed this, please share our content. We'd very much appreciate it. Thank you, and have a great day.